Today, we will find out if CANOE EIT has what it takes to survive a recession, and we will begin right now. CANOE is without a doubt a community favorite, as I'm sure you guys have noticed. Their share price is not in the green, as we have become very accustomed to. Initially, CANOE appeared to be defying the bear market. That's not a bad thing when you look at their holdings, which are mostly from the energy sector as well as financial and other sector companies supporting energy. It is easy to see why. CANOE's fortunes can literally rise and fall with oil and gas and the overall energy sector. Is that enough, though, to make them recession-proof? Before we paddle into a recession, let me know in the comments if you hold any CANOE EIT. I am still over-diversified into CANOE at the tune of 18% of my Wealthsimple TFSA. I am very grateful to see you all here in the home of free financial content on the YouTube. If you are new, please subscribe right now so you won't miss a single moment, and a huge thank you for that click. One of the first things we instantly think about when it comes to CANOE EIT is those dividends, with a yield ranging from 8 to 10% depending on their underlying share price. The 10 cents per share monthly dividend is, well, it's really nice. But as investors, we need to understand a company on a deeper level. Normally, when I see a very high yield, I want to know, is it sustainable, or am I thinking about investing in a sinking boat, or in this case, CANOE? With a bear market afoot and the clouds of recession coloring the sky, I really need to know that a dividend is sustainable in that recession environment. I have to know that the company is solid enough to weather what is coming. Is CANOE that company? That is a question we will definitely find out before the end of this video. Let's take a closer look at this fund. From the equity sector breakdown, we can see that energy and financials make up almost half of this fund. Healthcare is also another big part of this fund. We do have smaller stakes in materials, industrials, consumer services and products, as well as communications. This is a broader mix of sectors, and that is good. If we look at their investment geography, we do see that just over half of their investments are in Canada and nearly 40% in the US, with a small sliver of international investment. I do like their diversification, but that doesn't answer the question as to how are they preparing for a recession. According to Robert Taylor, Senior Vice President and Chief Investment Officer for CANOE, they have seen the current situation coming and have anticipated the effect of aggressive rate hikes on the market. Historically, CANOE has done well following periods of volatility. They are being defensive in their positioning, which includes maintaining higher cash levels and looking for opportunistic stock picks to drive returns for the fund. This all sounds fantastic, but how do the numbers look? As usual, we will begin with their market cap, and that is $1.995 billion. They also have a beta of 1.25, so they are a little more volatile than the market average. For the most part, the price of oil tends to drive a lot of their volatility. Their earnings per share is 4.35, and dilution is really not a factor with CANOE, which of course is another thing I love. Their price to earnings ratio is 3.50, which is awesome, as the industry average is 7.90. This goes a long way to showing us that they are not as overvalued as the industry as a whole. Their last 10-year history shows us a price maintained between $10 to $12, so we are definitely above that range currently. When we think of future growth, CANOE is expected to increase their revenue yearly by approximately 12.3%. This looks good initially until you compare it to the crazy earnings increase they experienced over the last year and a half. CANOE's revenues have grown 93.7% this year, even with the bear market, and it grew 62.9% last year. Holy banana bread, those are some pretty unreal numbers. When we look at returns, they have a 9.252% dividend yield at the time of recording. This, of course, translates into that 10 cent a month dividend. But, and this is the question, is that dividend sustainable? Their dividend has been very reliable for them, and they have a history of 10 years plus maintaining that stability. The sustainability of their dividend is all about their earnings. They are able to cover that dividend very easily. In fact, their payout ratio is only 27.6%. This does give them some wiggle room going into a recession. I am absolutely a huge fan of wiggle room. These dividends are normally the star of the return until you look at the growth returns. In 2021, their share price started at $9.85, and by year's end, we had a price of $13.33 for a return on investment of 35.3%. And when you add in the dividend, we have a total return of roughly 44.55%. That is absolutely insane. This year, it is a different story, as their share has dropped to $12.97. Thus, our ROI is currently negative 2.78%, though at one point the share peaked at $14.62 before the oil prices dropped off. CANOE is very interesting because that growth in 2021 was part recovery from the pandemic drop and the energy crisis helped by a certain little war. Historically, CANOE has been a dividend play only. A fantastic one, though. Will CANOE fall back into just being a dividend play? That is actually a very good possibility. Let's look at debt. At the end of 2021, CANOE's debt was $309 million compared to $1.9 billion in equity, which means they have a very low debt to equity ratio of 16.2%. I absolutely adore that number. However, that ratio has been increasing as CANOE has taken on more debt over the last 5 years. I can absolutely forgive them for that, as they are beyond being well positioned to cover their interest payments. Debt is really not a concern when it comes to CANOE. So what is the final verdict? CANOE has not lost any of its real shine. The growth is not so hot right now, but that is how CANOE used to be. A solid dividend player that they still are. Will we see insane growth again? That may be up to oil and gas prices. We will see more, but there is always the chance CANOE returns to their old ways, and if that happens, I am perfectly happy with that dividend. Invest in CANOE as a dividend play and accept any growth as icing on that cake. The fun does not have to end here because you can always watch my video on CP Rail that I have linked on the left, or you can check out the video on the right that YouTube thinks you will like. Your click will decide who is right, and I will see you in the next video.